But this moves us now into an aspect of the One Big Beautiful Bill that I believe is critical for you to hear. Critical for you to hear. If your goal is generational wealth creation. I don't want to make that your goal, but if your goal is generational wealth creation, you absolutely want to hear this next part. Because the next part has to do with something called bonus depreciation. Bonus depreciation. You see, when it comes to business ownership, and don't get me wrong, real estate, when done correctly, is business. Real estate, when done correctly, is business. Bonus depreciation is this opportunity for a business to take a deduction, an expense, if you will, to reduce their taxable income based on certain capital expenditures that are made that don't necessarily create an expense in the year that they are made. What do I mean by that? Well, typically when a business spends money on things, there are two ways that those dollars are treated from a tax perspective. They are either treated as a legitimate expense or a legitimate deduction from taxable income, or they are treated as a capital expenditure, which is not a deduction. So as an example, if I go out and I buy this pen, the government essentially says that this pen doesn't really have a useful life that is very long at all, right? Maybe a year. In fact, likely they'll view this as something that has a useful life of less than a year. So they say that because of that, when I spend the dollar this year or the $10 or the $20 or whatever it is cost me to buy this pen, when I spend that this year, they're going to deem that to be an expense because the pen exists in this current year from a tax perspective, after which it has no value from a tax perspective, right? So they allow me to expense it fully, right? So if it was $10 and I bought it this year, I would get a deduction from my taxable income of $10, right? But there are certain things that a business owner could spend their money on that the useful life of the thing extends beyond a year. So the government says, well, in those circumstances, you're not actually allowed to take it as an expense. You must depreciate it over its useful life. And there are different methodologies for calculating depreciation. And again, I'm not trying to make you a tax expert here. But the easiest way to think about it is what is sometimes referred to as the straight line methodology for depreciation, which simply says whatever the thing's useful life is, you get to depreciate that evenly over the useful life. So as an example, large equipment like this monitor, right? This is, I think, a couple $1,000s worth of an expense. As large equipment, this item has a useful life of more than a year, 5 years, right? So for the most part. So as a business owner, when I buy this, I do not expense it in the year I buy it. I have to take the total cost and divide that evenly over the useful life, 5 years. So if it was a $2,000 monitor, I know that I'm essentially going to divide that by 5, right? So take $400 of deduction every year for the next 5 years. And that is a depreciation expense, right? So that reduces my taxable income by the amount I'm permitted to depreciate in a given year. That is traditional depreciation. That's exactly what, like, depreciation is your ability to evenly distribute or in some other way distribute the cost of that item over time against your taxable income. So we have a couple of different ways that businesses get to deal with depreciation. And the first way is something called a Section 179 deduction. Section 179 deduction. Under the current law, it's about, there's a cap on it. The maximum amount of dollars you can deduct in a given year is is about $1,250,000, I believe it is, or $1,230,000, I think the number is. Regardless, it's a lot of money. It's in that seven-figure range. And that has to do with equipment, certain equipment that a business would buy, right? So let's say I bought a commercial HVAC system, right? Very large, and it cost me a few $100,000. I have the potential of being able to accelerate through a Section 179 deduction the entirety of the depreciation up to the first year cap of that thing I purchased. So instead of spreading it out over multiple years, I potentially have the ability to bring it into year one. That's a Section 179 deduction. And it applies to equipment. 179 deduction applies to equipment. And what that does is it gives the business owner the ability to essentially take a big deduction in the year that they buy it instead of spreading it out over time. Right? That's Section 179 deduction. Now, there are certain items of equipment that have special rules that a business owner has to deal with. The one that most people are aware of is automobiles, vehicles, right? Vehicle equipment. It's pretty hard pressed if you spend any time on social media, especially towards the end of the year, not hearing some supposed financial guru jumping on social media to say, oh, go buy a G-Wagon and use Section 179 to deduct it. Well, if they say that phrase, just know that that person doesn't know the law. If they tell you to use Section 179 to depreciate your G-Wagon, they don't know the law, because there are caps on vehicles to the tune of about $30,000 in year one under Section 179. So 179 does not give you the ability to deduct your G-Wagon. It gives you the ability to deduct a portion of the G-Wagon. You actually have to use another code section, right? You have to use another section under the tax code, and that's called bonus depreciation. The first thing that applies against equipment is Section 179. Then, for any amounts over the cap that particular depreciation section has for that item that is being purchased, anything above that, you have to use bonus depreciation. And what's interesting is the way bonus depreciation was working under TICJA, the Tax Cuts and Jobs Act, it was declining, meaning the maximum amount of bonus depreciation you could take was capped at a certain percentage depending on the year. And that percentage has started to drop by 20 percentage points every year. And currently in 2025, that cap is 40% of whatever the depreciable amount is. So again, let's make an assumption. Let's say, and again, these numbers are not exact, right? Because I'm not going to pencil them out for you. But let's say for the moment that you're buying a $100,000 G-Wagon. And let's hypothetically, let's just use the scenario of $30,000 as the cap. I believe it's $35,000 or so under 179, but let's assume that it's just 30. That would mean that $70,000 could not be depreciated under Section 179, and then you'd have to use bonus depreciation in order to get additional depreciation in year one. Again, I know this is complicated. I totally get it. But the reality is, under the current law, that ecosystem is capped at 40%. So of that 70,000, you wouldn't be able to deduct all of it. You'd only get 40% of that number. So another $28,000 of deduction. So you would not get everything. This is why when you're listening to people on social media, you have to be cautious, because they may not have a clue as to what they're talking about. They may have heard a soundbite that sounds really good, but they have no idea how it really works. Right? But that's how it works. Right? I'm a lawyer. I specialize in tax, estate, and business law. And I've been helping business owners across the country figure out the rules of the game so they can win. And this is important to know because the One Big Beautiful Bill is changing bonus depreciation. It's taking that cap, that 40% cap that exists in 2025, and bumping it all the way up to 100%, at least through 2030. So from 2025 to 2030, for equipment put into service post January 19th, 2025, so January 20th forward, equipment put into service, you'll have the ability to take 100% bonus depreciation. This is huge, guys, huge, because you get a major deduction in year one, and you don't necessarily have to pull cash out of your pocket to buy the thing, right? You could buy an HVAC system on credit. You could borrow. You could get into financing terms with the seller of the thing. So maybe you come out of pocket $20,000 to buy the $100,000 of equipment. You get to take a $100,000 deduction. It won't cost you $20,000 out of pocket. This is why this is so powerful for business owners. You get to major deduction for minor cost. This is powerful. And business owners who understand the rules can start to play the game to win. But bonus depreciation does not exist just for equipment. It also exists for real estate that has a business purpose, right? Real estate that is investment real estate, whether we're talking about residential real estate, commercial real estate, industrial real estate. Anything that has an improvement upon the land has the capability of creating major deductions for you. Now, what does this look like? Let's assume for the moment that you want to jump into investment real estate. Let's assume for the moment that you want to do that. And let's assume for the moment that you're either a business owner currently or a high income W-2 earner, and you have some capital that you want to put to work now and finally jump into the investment real estate ecosystem. Let's assume for a moment, I'm gonna map out a very quick analogy, like a sample, right? Almost like a case story, if you will. Let's assume that you want to go out and you want to buy whoa, that's a little bit too big. You want to buy a $1,200,000 property. Again, I'm using this number simply to make the math simple. You could add zeros to this. You could take zeros away from it. I just want to illustrate the math behind this. Let's assume, again, you'd have to run an actual analysis to figure this out, but let's assume that $300,000 of this amount is land. Well, land is never depreciable. Never depreciable. You can't depreciate land. But the improvement upon land, $900,000 improvement upon the land, this is depreciable. $900,000. Now, bonus depreciation when it comes to real estate has other rules, right? There's certain rules that you have to be aware of. Bonus depreciation against equipment, you have essentially the cost of the equipment, right? When it comes to real estate, it only applies, bonus depreciation only applies to stuff that has a less than 20-year useful life, right? So when you think of real estate, there's a lot of different components that go into a real estate asset, right? You have your doors, you have your floors, you have your cabinets, you have your fixtures, you have your windows, right? All of those separate things have a different useful life. But a lot of those things have a useful life that is less than 20 years. Now, I'm going to share with you a rule of thumb. Would you guys like to learn a rule of thumb? Would you guys like to learn a rule of thumb? When you're looking at real estate that is traditionally residential, whether we're talking about a single-family home, a multifamily home, up to 4 units, so a quadplex, a triplex, or a duplex, right? On average, about 1/3 of the total improved value, about 1/3 of it is comprised of assets that have a less than 20-year useful life. So in the context of this scenario, that would leave $300,000 of less than 20-year property. Under the One Big Beautiful Bill, this entire amount is deductible. This could be used to reduce your taxable income. Save you guys significant dollars, a $300,000 deduction in the year you put this into service. But again, coming down to this, how do we take advantage of this? Well, this is a deduction against incomes. But here's the thing. Here's the caveat. There's something called the passive activity loss rules, right? These PALS rules, passive activity loss rules, stipulate, and this is since 1986, guys. So this particular rule has been around for a long time. Since 1986, passive income, let me say this, passive losses, they can only be used to offset passive income. Right? So if you have a passive loss, and real estate that is for investment purposes is by default passive, right? No matter what, if you have an investment property, whether you're renting out a room in your house, whether you're renting out the entire house, whether you're renting out a commercial building to an office, right? Like, doesn't matter. Real estate by default is considered passive when it is used to generate income, right? So if you have rental income. So the passive activity loss rules, they basically stipulate that losses can only be used to offset income that is passive. But there are exceptions. There are three of them, right? Three exceptions to the passive activity loss rules. The first is that if you earn less than $150,000, you have up to $25,000 of passive losses that can be used to offset your W-2 income. It can be used to offset your income with regard to businesses that you own, right? If you make less than $150,000 of modified adjusted gross income. Now, it starts to phase out at $100,000. And by $150,000, there's no more, right? And it's essentially $2 for every dollar, right, above, or a dollar for every $2 above. That's the way it works. So by $150,000, you can't use exception number one, right? Exception number two is what is referred to as the real estate professional status, REPS. Once you hit $150,000 of MAG, modified adjusted gross income, right? Once you hit $150,000, you can't qualify for exception one, right? Can't qualify for exception one. Exception two is real estate professional status. This is a multi-part test. You have to meet the qualifications of every part. Part A is a time test. You have to spend 750 hours per year engaged materially in the trade and or business of real estate. And there are 11 different types of things that the IRS looks to. We actually teach our members exactly how to do this. But 750 hours in the trade or business of real estate. B, it must be the majority of what you do. Majority of what you do. REPS requires you to have 750 hours engaged in the active trade and or business of real estate. There are 11 different criteria that go into that, but it also must be the majority of what you do, which means if you are a W-2 employee or you have a business that you're engaging in regularly, it is highly improbable that you'll qualify for the REPS exception. Enter exception number three. This is the short-term rental loophole. This is also a multi-part test. Part A is a time test as well, but it's only 100 hours engaged in the active trade and or business of real estate. And no one else can work more than you in this business, which means if you had a third-party property manager, that wouldn't work because it's pretty hard to say that you worked longer or more time than the actual property manager did. And C, the average stay of a tenant is 7 days or less. 7 days or less. Hence, short-term rental, right? Airbnb, VBRO, home away. But when you qualify for this, you get this opportunity to pull those passive losses from depreciation, specifically bonus depreciation, and apply it against all of your other income. Massively saving taxes. Massively saving taxes. So in the short-term rental exception call, yes, this is owner managed. Owner managed. In the reps environment, you don't have to be managing the entirety of the property yourself. You just need to be sure that you in reps, you are not working more in something else. So if you were working 40 hours somewhere else, you'd have to work essentially like 40 plus hours in real estate. That's just not probable, right? It's just not probable. But here's the thing. A spouse who isn't working can qualify for you, right? If you have a spouse that doesn't work, your spouse can qualify for reps, and it applies to the entire return if you're married filing jointly. So you have this capability of capturing major deductions under this rule. This is one of the reasons why I wanted to jump in here today, right? The Big Beautiful Bill is a pretty phenomenal thing when it comes to giving you a guide path toward the creation of generational wealth. And I say that because real estate is a wealth creation tool. Real estate is a wealth creation tool. And I say that fervently. And this is going to sound very strange for someone, because one of the companies I own is a private wealth management firm. But hear me clear. You guys ready? You guys ready to hear the truth? It is nearly impossible to become wealthy through traditional investing. It is, let me say that again, because this is a writer-downer. It is nearly impossible to become wealthy through traditional investing. Traditional investing is great for accumulating wealth, preserving wealth, like working toward, but it's not a wealth creation tool, at least not for the vast majority of people who engage in traditional investing. Real estate, on the other hand, is a wealth creation tool. Business ownership is a wealth creation tool. So this gives us the ability to take advantage of tax law that can put you on a path for generational wealth creation. That's why I wanted to jump in here today, because so many people are getting so caught up in the politics of what's happening right now in Congress that they are not seeing through to understand how they can start to take advantage of a major shift in tax law. Major shift in tax law. You have the ability to potentially take advantage and let the government become sort of like this partner helping you to subsidize the acquisition of real estate because of the deductions that are now possible. 100% bonus depreciation in the scenario that I laid out. Gives us the ability to potentially create $300,000 of a tax deduction. And now you have an asset that cash flows. And you still have other deductions, right? Because you still have $600,000 in this scenario. You still have $600,000 of ongoing depreciation that happens in year 2 and 3 and 4 and 5, right? Now, it's not all up front in those years. It's spread out over time, but it's spread out over the useful life of the items that are still outstanding. You have major tax benefits by engaging in understanding first the rules of the game and then playing that game to win. Guys, I hope you found this helpful. Hakeem Jeffries is still talking. He's still in his magic minute that is now, 5 hours in? 6 hours in? Yeah, he's still talking. Now remember, what he is blocking at the moment is not the vote on the actual bill, right? He's blocking a vote or the movement on the rule to consider the bill. Right, so it's an administrative thing that he's creating a roadblock to. Guys, I hate the government, but I love America. And if I can help enough Americans go out there and become financially free, that is how we change the world. And freedom, from a financial perspective, starts with knowing the rules of the game you're playing. Because let me tell you this, the vast majority of people out here are playing Twister while the wealthy are playing chess. And if you are playing the wrong game, you will most certainly lose. And even if you're playing the right game with the wrong set of rules, how could you ever hope to win? I want you to win. I want you to learn the rules. If this has been helpful, Make sure that you follow this channel. We're trying to build this channel up so we can bring financial literacy to business owners, to high-income W-2 employees, to investors all across the country who want to take a step in the direction of generational wealth creation. So make sure that you follow if you have not done so already. If this has been valuable, make sure you let me know. I can't wait to have an opportunity to share more with you. So until then, I wish you well in your journey. Bye for now.